And today's our guest is Nic De'Angelo from Saint Investment. Welcome, Nick. How are you doing?
I'm doing great, Rama. Excited to be here and glad to get some time for us to connect.
Yeah, absolutely. Thank you very much. A little bit about Nick. Nick, as CEO and founder of Saint Investment Group, he leads a veteran team acquiring institutional-grade real estate assets nationwide. Right now, 20-plus state portfolio, 24 projects, and 500-plus loans showcase their strategy-driven prowess. Is Saint on track to raising 100 millions yearly. So with that, you want to add anything to your background?
That's a pretty good high-level introduction. We're pretty excited in these economic times that we're all dealing with, right? You have a pretty high-level, highly experienced, intelligent audience. It's a lot of changes very quickly. So we've been able to update a lot of the Saint strategies that we have going on. Rama, you and I were talking about some of the economics that we're both seeing in the marketplace today.
Yep.
So our newest venture you kind of mentioned is the income fund that we're moving into that deals with a lot of real estate debt. It was requested by a strategy and a structure like that was requested by a lot of our investors to offer something more flexible, it's more consistent. So it's been interesting in this environment, and that's what we've been leaning more into is our economic strategies, implementing through the income fund.
Awesome. Thank you. So how did you get into real estate space, Nick?
That's a great question and one I'm pretty passionate about. So real estate, candidly, I always wanted to be on the entrepreneur side of business. I wanted to be in something where we could really take a lot of initiative. I started in construction. I started in banking thereafter because I didn't like construction a whole lot. And what I learned was seeing all of these different businesses that were successful and seeing all these different avenues and seeing the opportunities that people could tap into with a relatively small team that was focused on really good opportunities. And then I consistently saw teams that were focused on real estate investing were by far and wide had the lifestyle, the team, the structure, and the opportunity that I wanted to be a part of. So I was very young, but I made my decision absolutely to pursue the real estate space. And I just tried to get it as close as possible to the successful people in real estate that I could. Luckily, I do some through some family, some extended friends, et cetera, and just tried to help them and add value to them in any way. I was doing leasing calls at a very young age, real estate marketing at a very young age, and really getting paid pennies on the dollar or not at all, but it got me close to people that were doing big deals. So I always wanted to stay close to high net worth individuals, learn everything I could, and add as much value as I could, whether it was for free or very low amounts.
Sure. Thank you. Thank you for sharing that. Share me some lesson learned from that.
Yeah, there's a lot. One of my favorite ideas was, some people will put it, more money, more problems. I prefer to look at it. What I learned very on is that you can measure a person by the quality of their problems. So people with a lot of money, there was a different tier of issues that they were dealing with, a different tier of concerns. And so real estate just crossed so many of those. They were dealing with massive things like tax consequences of making a lot of money. That's a win, Rama, right? That's a huge win, but it comes with the price and it comes with these tax issues. So what can you do to be on the right side of taxes that the government incentivizes you to go towards for tax sheltering? That was one. Also, it was things like generational planning that really impressed me, and it helped me. I have an immigrant family. Each generation has made progress in the United States, and it's something I'm very proud of. And these very wealthy individuals, they thought in terms of generations. And it was something that I never forgot because of how impressed I was with that degree of long-term planning. Many people are paycheck to paycheck. That's we're talking 100 years versus 30 days, 12 months, or 1 month at a time. So long-term planning, thinking bigger, understanding long-term large problems and how to get ahead of those were things that it really, like the game of chess, you're thinking multiple moves ahead. What if you're thinking multiple games ahead, multiple months, years, decades, generations ahead? And that really stuck with me as something I wanted to emulate, something I wanted to learn from and be like.
Awesome. You need to think like decades or, 100 years or 200 years like that. Yeah, great stuff. So share me a little bit more about your products. You mentioned a couple of products, right, during our offline chat. Share me a little bit more about those products.
Sure. So what we are 100% focused on right now came from, which is our income fund. We're 100% focused on our offering of our income fund. We work with, like I said, we started off with really ultra high net worth individuals, people worth 9 figures, people that were very advanced real estate investors. And I wanted to learn and be close to them as much as possible. What I learned was applied to more investors as we grew to Saint. We wanted to offer the same level of strategy that these ultra high net worth investors were using and utilizing to entry level investors or much younger or much less high net worth investors. So that's what we've done. And over the years, we've been able to work with so many investors that the discussions of what they're looking for in their portfolios has been valuable feedback. And we can take what they're looking for. We can mix that with economic data that we're seeing. We spend a lot of time and money on economic research, and we can put those together for the best possible strategy that we can in a current market or in any market that we're entering. What we're seeing, absolutely no question for how we operate and how we strategize into markets, is income strategies as being the best fit for our investor base. So what that meant on our side, we had my career and Saint's career started on the acquisition side. We were buying distressed debt. We were buying distressed properties in the wake of 2008, the financial crisis. So because of that, we have long-term relationships with banks. We have long-term trust with financial institutions. And we kept seeing this debt coming up. Hey, buy these mortgage notes for these single-family homes that maybe they've missed some payments or you could get them back on track, et cetera. And we did. We've been buying them for many years. And then there was an opportunity as the market shifted to continue acquiring more and more of those and build a portfolio. So what we did was we acquired over 500 mortgages in a portfolio, packaged that together, and put the income fund, the Saint income fund together so that investors in this environment where syndications, some people might be a little leery of maybe a 5 to 10 year hold, unless it's a really good purchase, right? If it's a really good purchase, it makes sense in this market. Absolutely. But many people were just not sure on the market on our investor side. So they wanted something more flexible. What we did was we pegged something that's pretty much double what you'll see in a lot of treasuries, 8%. And we said there's a minimum hold period of 12 months. And after that, we would return investors' money within 90 days. So with that flexible structure, it allowed our investors, again, many of them are planning much larger portfolios. It allowed them a safe haven for cash during an economic environment with a lot of ups and downs with interest rates, with a lot of inflation concerns, with a lot of questions on treasuries or stocks, et cetera. And so it could balance out. Many of them had already invested in syndications or longer term holds. So while those were, moving forward with those game plans, they could invest in something that was higher yielding, that was still very flexible and real estate backed. So it really rounded out their portfolio in a big way to add on the fixed income side. So that's what we leaned into for that product offering. And it's been going really well. It seems like it's a really good fit for our investors. And it's a really good fit timing wise with how tight housing is and with how rock solid housing has shown in, the last multiple years. So that's kind of where we're at and where we got is, our investors were asking for something. We already had an asset base and an asset strategy in the space. So we just combined the two and really have been able to offer a lot for investors for that.
Awesome. Thank you. And let's switch gears towards economics, how it's impacting. You have strong, understanding or background with that, So what are the factors that impacting current economic situations and how exactly your company or, investors need to navigate next, maybe 12 months or 18 months or 24 months?
I love the economic discussion. So if you think about where we're at today, let's back up the clock a little bit. We'll talk middle of 2022. In the middle of 2022, inflation hit over 9%. We hadn't seen that for decades, right? That was a shock to everyone, probably including the Federal Reserve. I don't think they expected it to go that high. Since then, everybody's high-fiving, they're cheersing, they're celebrating the fact that inflation has gone down significantly. But you have to give it to Jerome Powell, right? You have to give him the credit of he's very clear that we're not out of the woods yet. Even though inflation shows threes in many categories, and many indexes in these indices, he's being very clear with the public that they have no intentions of lowering rates anytime soon, even though at the last Fed meeting just recently, they did not increase rates. He's saying, we have no plans whatsoever of lowering rates anytime soon. Now, the market's still celebrating, hey, we're on track, hey, this is coming. But if you peel back the layers and you look below the surface, especially at the bigger players, the big money, what they're doing, and then the sets of trends and the indexes behind that, you can see that we are very far from out of the woods. So what we're looking at, Rama, to answer your question in very big detail, we're looking at some of the big names. We're looking at the Rick Reeders, right? We're looking at the Bill Ackmans, the Howard Marks, collectively have trillions under management. They're all very clear and very open about the fact that they're making 10 to 20 year bets on high inflation, that inflation's that sticky. Bill Ackman just made $200 million short-term betting against U.S. treasuries, saying, hey, people have an undue sense of optimism about certain parts of the market. Now, if you look at the actual trends for inflation, you can see CPI trending a little bit up, not good. CPI, Consumer Price Index, which, as your viewers know, is the general best index that most often is looked at for consumer inflation, how much prices are going up. But CPI is just one measure. There's precursors to that. There's things that are leading indicators that give us an idea of where CPI is going. There's things like PPI, Producer Price Index, manufacturers, producers. What level of inflation, of cost increase are they going through? What we're seeing on PPI is that's actually going up even more. So there's a good idea for that will impact consumers, us, your viewers, your audience, that we're not out of the woods, and that actually may go up in the near future for inflation. Now, that's an oversimplified view of everything, but we're looking on a broader scale. And what we're seeing for our calculations, kind of all in, we're expecting that the federal funds rate for at least the next decade will be around 3-4%, which calculates in the range of rates to consumers like us or investors like us, maybe 5 to 6% for a very long period of time. So that's the data we're looking at. I can drill into that infinitely even more, or I could shift a little bit, Rama, and tell, kind of give you some feedback of what we see investors would experience on their side.
Yeah, I'm open for if you want to dig a little bit deeper, next layer, I'm totally open. Yeah. Then we'll jump in the investor side.
Sure. That's a great question. Additionally, kind of below that, we're seeing demographic trends in the US. So if you look at, again, some of the big names and what they're looking to for their resources, we're seeing that the last, let's say, since 2011, 2013, all the way to 2019, that was the easy money era, right? I mean, it being in multifamily. I know it being in the syndication space, that money was different. So the question is, demographically in the United States or globally, because rates were relatively low across the world, especially in major economies, why is that? In the US, you see a lot of that driven from demographics. So where we're at today, especially accelerated by COVID, we have the baby boomer generation, the largest generation in US history up until that point, and the wealthiest. So it's the largest generation, and they had a lot of cash, right? They are exiting the workforce. This, I believe it was 2022, was that the mid-age of a baby boomer was 65, and they had begun exiting the workforce over half. So that means it's only going up as far as wage pressures, meaning inflation just by wages, because the biggest demographic baby boomer generation is exiting, and replacing them is Generation Z, Gen Z. They're tiny. The smallest generation we've had in many, many years, arguably the smallest for the modern day US. So there's just this huge drop off in labor. And additionally, all these wealthy baby boomers are taking their money with them. So if you look at the last decade, it was the wealthiest the baby boomer generation is ever going to be, because they had the highest income of a generation between 55 and 65. That age range represents, I think, 70% of the wealth in the US. So 70% of that wealth there. Also, their children are leaving the house during that period of time. So their expenses are going way down. So they have more money, they're making more money, they've been saving for a long time, they're making more money, and their children are leaving, so their expenses decreased. So they invest, right? So that's cheaper, downward pressure on rates, expectation of yield. You were in it, I was in it. The everything bubble is what they were calling it, where every asset was overpriced. Now we have a weird situation. The cost of capital has gone up. Inflation's gone crazy. Rates have gone crazy. Private money is at these ridiculous levels, right? All that to be said, we're in that environment that we're in today. We're saying at the lowest 5 to 6% rates that many people are calculating for 10 to 20 years. The crazy part is that's actually a return to norms. If you look at the last 100 plus years in US history for rates, 5.5%, 6%, that's dead center, middle of the road for what rates can be expected during those times. But the weird thing that we're seeing, and I know you're seeing this too, I know we're seeing this, is that sellers have not adjusted their prices to the new markets, right? So that to be said, how that affects where we're at today and the strategies that you or I would use as syndicators or as investors with all, bringing in other investors, limited partners, is that we're looking for things in a market that is still landing. And so on the seller side, a lot bought at, I was seeing cap rates sub 4% for different parts, even in industrial. I know multifamily was seriously impacted as well on some really tight pricing. So all that to be said, where are we at today is I think there's huge opportunities, especially 2024. I think there's huge acquisition opportunities where if you trail that out 5 years, pricing in the next year should settle down significantly where sellers that have to get out or have loans that are having upcoming issues or have workouts they need to do with the bank or with their investors, et cetera, those prices will start to get sorted and we'll start to see the prices come down to more realistic levels. So that's my bet for the next year. And then I think it'll be a really good time to buy in the next year as well.
So would you also share from investors' point of view, investors' expectation or how these things are impacting investors?
I would say if, when we're looking at inflation sticky for the next decade plus, again, that's our bet. That's what all our data shows. That's the case. Stock market's a little scary for me as an investor. I'm looking at that going, wait, so you're telling me high inflation and high rates? What does that do to companies, right? We've seen a boom time in the stock market, the largest bull market in stock market history because money was cheap. Capital was cheap. Those things were easy to get a hold of. Now, I don't see that bet. I hold a lot in stocks. I keep it simple with ETF myself, but I have a lot of investors that are moving out of stocks and over to real estate. I think that's probably a smart play. I'm doing the same. I'm, moving down my stock holdings, moving up my real estate holdings because I just don't see it as a good hedge against inflation. I don't see those companies performing as well in a higher rate environment. So that's one. Two is the bond markets are very volatile right now. Look at the buying pool of bonds over the last 12 months, most of the last several years, like 2-3 years. If you look at those, look at Russia. They're not buying U.S. equities, they're not buying U.S. bonds. They're not buying T-bills. China is limiting their holdings or selling off completely. And many other countries don't even have the money to look towards U.S. treasuries for that. So the buying pool is decreasing by quite a bit. Bonds have had massive issues, so I'm not putting my money there. So where would I put money? Well, it's not crypto. You saw that Sam Bankman-Fried, he just went down. So while I think there's interesting plays in crypto, it's not safe enough for me to put my nest egg or my core investing. So I'm going back to real estate. Full circle, even with rates, even with everything, nothing is offering, in my opinion, for my analysis, for Sam's analysis, nothing in the market is hedging bets better than real estate. Now, for me, I'd split that between fixed income that's much more flexible with a set rate and longer term, more of the syndication side. But if you're betting on both and you're putting money in both, I think that is absolutely the safest play in the investment space right now.
Awesome. Thank you. Would you share any best experience so far?
Sure. So so that investors understand what we're seeing in the market today, because it's, we're boots on the ground. There's sometimes, Ram, I know you're very involved in the market and the day-to-day process. Sometimes investors more on the limited partnership side or that are not as active in the space, they don't see what's happening on the front lines. So I'll give you an example of what we're seeing in the marketplace. One, we buy a lot of debt. We buy a lot of mortgages for the income fund that we have, right? And then on the other side, I'll give you an idea of the syndication space. We buy a lot of industrial assets, right? So the mortgage space is so driven. It's so driven by average consumer, average individual, average American, middle class. That's why we like it, is because our bet long-term is on the US. Because no matter what the problems are in the US, most of the rest of the world is having much bigger problems in the same categories. So there's a few countries that I'd bet on right now. The US is top of that, absolutely. And if you look middle of the road and you look at the mortgage market, things are tight. They're actually surprisingly tight, because as much as we hear about, oh, we can't find homes and, oh, this and that and ups and downs and all, the reality is 90% of the US mortgage market is locked in at low interest rates. So they're very sheltered from the overall market, highs, lows, whatever. If you have a rate between 3 and 4%, you're locked in, you're safe, right? You're pretty insulated from market conditions within real estate. That's one side. The other side, the syndication side, what we're seeing consistently, we buy below market. We're very aggressive on our purchase price. So that's built into our long-term, our syndication strategy. We've averaged north of, I think our last calculation was 35% IRR. So we're very, very, very aggressive on our acquisition side, on the industrial side. But industrial is a weird space. It does not use the same fundamentals as housing or multifamily or single family. So on the industrial side, we get this interesting look into imports and exports, most importantly for how we invest. We invest near ports. We invest near distribution ways with a lot of freeway access into other states and throughout the country. So what we see and what we track are a lot of shipping channels and imports and exports from other countries. So what we've seen is a significant shift in the way that Americans are buying goods and processing goods. We're buying here close to the southern borders. We like the long-term relationship with Mexico right now. I think that that's very valuable. And I'm seeing even a lot of banks betting on southern industrial as a good long-term market for the hard asset side. We buy near ports. So we like a lot of parts of Texas for that. We like a lot of parts of Southern California for that, ports of Long Beach and ports of Los Angeles. So we're tracking a lot of those. And the good news is, I think that's stable for a long-term situation. While we think that another one of our bets that sounds obscure and global, but actually affects US citizens a lot and consumers a lot, we're seeing the price of Chinese goods increase quite a bit. They're having labor cost issues there, right? That might sound like a whole world away to the US citizens, but the reality is we buy low-priced consumer goods from China, all of us. That's basically Amazon's business model, right? There's cheap goods to Americans, 1 to 2 day shipping. That's Amazon in a nutshell. Those price of goods are going up. Not just the manufacturing costs, not just the shipping costs, but also the labor costs of Chinese goods and services are going up, and those are baked into goods. That's, again, producer price index as that goes up and as those things are affected. So we see those go up. We see pricing go up. We see that something we're watching in the future for the industrial side. For the mortgage space, long-term, we feel it's pretty insulated. Our portfolio is doing our performance month over month of on-time payments is 96.7%. So we're seeing a strength of the middle-class Americans. We're seeing rising incomes. We're seeing that they're insulated against a lot of economic environments and economic changes. And long-term, housing looks to be strong. The biggest issue that we're seeing in the housing market today is these freaking high interest rates that probably aren't going to go away for a while. But those with 20 or 30 years left on their mortgages are so insulated that unless unemployment takes a massive dump and absolutely ramps up to a huge level, which Jerome Powell is pretty anal about that. I think he's pretty on top of that. That's not my bet. I think that without that huge spike in unemployment, that market is extremely solid. Multifamily, housing, single family, I think that'll be rock solid moving forward.
Awesome. Thank you. So much great information. So would you also share any challenging experience?
Absolutely. We reached a point in time where we were working a lot with institutions. And one of the interesting things when you're dealing with institutions is their perspective on the market is usually they want to be the last ones in and the first ones out, right? They want to be the safest of everything, and they want the safest dollars and the safest strategies. So even in markets where there's extremely safe investments where you go, look, a tenant's already lined up, they're national credit, they're very well established, et cetera, et cetera. We saw the rockiness of institutional investors start to affect a lot of other investment classes and a lot of other investment strategies, really. It kind of was across the sector. Once we started feeling institutional partners backing out of deals, especially with friends and colleagues and people that we know in the investment space, we started seeing the syndication side freezing up quite a bit for the markets that we focus on. So that's interesting, right? What pressure and what issues does that put on deals? Well, if you're trying to exit deals and there's less capital involved, maybe you have to kick that back. Additionally, we invest with others all the time. We invest as limited partners. I'm still because if people are better operators in certain classes than we are, I want to invest with them, right? They can make more money for us than we would in that space. So we're seeing a lot of distributions not happening or even capital calls happening. So that gets complicated. So if you're a portfolio investor, I'm sure many of your listeners are invested in multiple projects across multiple things. They've got to budget differently for that, right? Because if some of those projects aren't distributing or even asking for money and doing capital calls, then that puts them in an interesting position where they actually have to hedge their bets, or they can't fully rely on that income from some of those projects. So we were in a similar position where we analyzed a lot of that, just saying, how far does this go and how long does this go? And our solution on our side was to, peg some other things at fixed income and put some more money that direction to kind of hedge that. So we have a long-term upside potential while having something a little bit more fixed and set. So that's been one issue that we've dealt with in the marketplace. I'd say the other has been most consistently has been working with banks. I think they are not sure if they're in or out on the market. And you get a lot of indications that they're in, but they're actually out. They don't want to tell their competitors that they're not competitive, that they're not in the market. And so we've been dealing with that and, really expanding our relationships quite a bit to make sure that our friends are in a lot of good places and that their money is active and that they want new friendships. So we're doing a lot of that to diversify a little bit relationships, especially with banking.
Got it. Thank you again. What's your company's plan for next 2 to 5 years?
Great question. We're always thinking about that, is the long-term plan and what that looks like. For the next at least year, the income fund is our absolute strategy. For what we have done, I just put $500,000 in our own fund. So we are absolutely 100% seeing that as the best opportunity right now with the way that we invest. So the income fund is the absolute focus. My bet, again, I kind of mentioned, I think the syndication in the longer term, that 5 to 10 year hold period for commercial assets, that's going to have a great buying opportunity in the next year. So we're keeping in touch. We're very involved in our markets. We know our brokers. We know exactly what to look for. And, our acquisitions team is ready for that. So my bet is in the next year that we'll be starting to look at syndication deals, understanding that it used to be 1 in every 200 that we purchase. Now it might be 1 in every 500 or 1 in every, 1,000 even, God forbid. But what we're looking for to achieve the results we want, it might take that. And we're okay with that effort. And that's our game plan. But that's what we're expecting, that we'll start syndication back up, the 5 to 10 year strategies in about the next year. But I do not see a single better opportunity for how we invest than a fixed income strategy in this volatile environment.
Awesome. Thank you. And any books that impacted your life?
Oh, quite a few. Long-term one that I return to quite a bit is called Thinking Strategically. It's basically game theory. So, a scientific evaluation of why we make decisions, how to make the best decisions. I return to that book all the time. It literally I feel like it retunes my mental strategy on many things in a really good way. And then another book that I've been reading, it's very short, it's almost a pamphlet, is Seneca, right? So it's a lot of stoicism and strategy just of how to deal with your soul and how to look at your life. The book I'm reading there is by Seneca, is The Shortness of Life, because I work a lot of hours. I'm sure you do too, Rama. I have children. I have a large family. There's many things that are really important to me, and I don't want to misalign my efforts on anything. I'm still fine with working a lot of hours, but when you have a bigger strategy and a bigger picture, the stress isn't as much. It's not as difficult. It feels very light because you understand the most important thing. So two ends of the spectrum. One is ultra granular, scientific, mathematic, data-driven decision-making, and the other is very philosophical. And between those two, I just keep reading the same, books in those categories quite a bit.
Awesome. Thank you. Thank you for sharing. And how can listeners can connect with you?
Sure. We have a ton of free resources that we try to give out. We don't do any courses. We don't do any paid anything, right? We give out everything for free. We have, hour-long, 90-minute webinars that we do on deep economic strategies and topics every month. So the best place for listeners to find that, if they want to dig into some of these details and discussions a lot further, is saintinvestment.com/resources. And that's everything. That's all our webinars that we do, our topics, our slides for the webinars, everything's free. We're happy just to provide that because, your investors, our investors, everyone's investors, the more they understand the market, we find that they're the better investors.
Awesome. Thank you, Amal. Thank you for sharing, your expertise on overall global economics and, how it is impacting overall, multifamily or real estate market, and also sharing your best and challenging experiences and also books. Thank you very much. I really appreciate it.
Absolutely. I had a lot of fun with you, Rama.
Sure.